Candlestick charts are a powerful tool for traders. They originated in Japan centuries ago. Rice merchants used them to track the price of rice. Today, traders all over the world use them to analyze financial markets. Each candle tells a story about the price movement within a specific time period. This could be 1 minute, 1 hour, 1 day, or even 1 week. By looking at a series of these candles, you can start to understand the market's mood. You can see the battle between buyers and sellers. This visual language is much easier to read than a simple line chart. It gives you a deeper insight into market psychology and helps you make better informed decisions. To understand a candlestick, you must know its 4 key price points. These are the open, high, low, and close. The body of the candle is the wide rectangular part. It shows the range between the open price and the close price for the period. The thin lines sticking out from the top and bottom of the body are called wicks or shadows. The top of the upper wick shows the highest price reached during the period. The bottom of the lower wick shows the lowest price reached. By combining these 4 pieces of information, a single candle provides a complete picture of the price action, making it a comprehensive tool for technical analysis. The color of the candle's body is very important. It tells you the direction of the price movement. A green or sometimes white candle means the price went up. This happens when the closing price is higher than the opening price. We call this a bullish candle because buyers or bulls were in control and pushed the price higher. On the other hand, a red or sometimes black candle means the price went down. This occurs when the closing price is lower than the opening price. We call this a bearish candle because sellers or bears were in control and pushed the price lower. These simple colors give you an instant visual cue about market sentiment. Learning to read these candles is like learning a new language. Each candle is a word, and a series of candles forms a sentence. This sentence tells you who is winning the constant struggle between buyers and sellers. Are the bulls charging ahead, or are the bears dragging the market down? A long green body shows strong buying pressure. A long red body shows strong selling pressure. The length of the wicks also provides valuable clues. Long upper wicks can suggest that sellers are starting to challenge the buyers. Understanding these basic elements is the first step toward mastering the art of candlestick analysis and becoming a more proficient trader. Once you understand individual candles, you can start to identify patterns. These patterns are formed by 1 or more candles and can signal potential price reversals or continuations. One of the most powerful bullish reversal patterns is the bullish engulfing pattern. This pattern appears after a downtrend. It consists of 2 candles. The first candle is a small red candle. The second candle is a large green candle that completely engulfs the body of the previous red candle. It opens lower than the previous close and closes higher than the previous open. This pattern shows a dramatic shift in momentum from sellers to buyers, suggesting the downtrend may be over. The opposite of the bullish engulfing is the bearish engulfing pattern. This is a strong bearish reversal signal that often appears at the top of an uptrend. It is also a 2-candle pattern. The first candle is a small green candle, showing the uptrend is still active but perhaps losing steam. The second candle is a large red candle. Its body completely engulfs the body of the prior green candle. This indicates that sellers have suddenly and forcefully taken control from the buyers. When a trader sees this pattern, they might consider that the uptrend is losing its strength and a potential move downwards could be imminent. Another crucial candlestick to know is the doji. A doji is a special candle that signals indecision in the market. It forms when the opening price and the closing price are very close to each other, or exactly the same. This results in a very small or non-existent body. It looks like a cross or a plus sign. A doji tells you that there was a fierce battle between buyers and sellers, but neither side could win. The market is uncertain about its next direction. A doji is most significant when it appears after a strong trend, as it can be an early warning that the trend is about to pause or reverse. These 3 patterns, bullish engulfing, bearish engulfing, and doji, are fundamental building blocks of candlestick analysis. They are visual representations of market psychology. The bullish engulfing screams that buyers have taken charge. The bearish engulfing shouts that sellers are now in command. The doji whispers that the market is hesitating and unsure of its next move. By learning to spot these patterns on your charts, you gain a significant advantage. You can anticipate potential changes in price direction before they become obvious to everyone else, allowing you to position your trades more effectively and manage your risk with greater confidence. In trading, price does not move in a straight line, it moves up and down, creating peaks and valleys. These peaks and valleys often form at specific price levels known as support and resistance. Support is a price level where a downtrend can be expected to pause or reverse. This is because there is a concentration of buying interest at this level. Think of it as a floor that holds the price up. When the price falls to a support level, buyers see it as a good value and start buying. This increased demand stops the price from falling further and can even push it back up. It's a key area where buyers are stronger than sellers. Resistance is the opposite of support. It is a price level where an uptrend can be expected to pause or reverse. This happens because there is a concentration of selling interest at this level. You can think of resistance as a ceiling that prevents the price from moving higher. When the price rises to a resistance level, sellers believe the price is too high and begin to sell. This increase in supply stops the price from rising further and can push it back down. Resistance marks a zone where sellers are stronger than buyers. These levels are critical because they represent the memory of the market. Identifying support and resistance on a chart is a straightforward process. You look for historical price levels where the price has struggled to move past. To find a support level, look for at least 2 or 3 previous lows that are at roughly the same price. You can then draw a horizontal line connecting these lows to mark the support zone. To find a resistance level, you do the same thing but with the highs. Look for several peaks that occurred at a similar price level and draw a horizontal line to connect them. These lines are not exact barriers, but rather zones where a reaction can be expected. It is important to remember that these levels are not permanent. A strong enough trend can break through them. When a support level is broken, it can often become a new resistance level. Similarly, when a resistance level is broken, it can become a new support level. This is a very important concept known as role reversal. Traders watch these breakouts closely. A breakout above resistance can signal the start of a new, stronger uptrend. A breakdown below support can signal the start of a new, stronger downtrend. These levels form the map on which the market battle is fought. Using candlestick patterns alone can be effective, but their predictive power increases dramatically when you combine them with support and resistance levels. A candlestick pattern is like a signal, but the location of that signal is just as important as the signal itself. Imagine seeing a powerful bullish engulfing pattern. This is a good sign for buyers. Now imagine seeing that same bullish engulfing pattern form exactly at a major support level. This is a much stronger signal. The support level already told you that buyers were likely to step in, and the candlestick pattern confirms that they have indeed arrived in force. This combination works because it provides confirmation. Technical analysis is about stacking probabilities in your favor. When multiple signals point in the same direction, your confidence in a trade idea increases. For example, if the price is in an uptrend and pulls back to a known support level, you should be on alert. If a doji candle then forms at that support level, followed by a bullish engulfing pattern, you have 3 distinct reasons to believe the price will go up. The uptrend is the context, the support level is the location, and the candlestick pattern is the trigger for action. This synergy creates a high probability trading setup. Let's consider another example. Suppose the price has been rising strongly and is now approaching a significant resistance level that has stopped the price before. As a trader, you should be cautious. If you then see a bearish engulfing pattern form right at that resistance ceiling, it's a powerful warning. The resistance level suggested that sellers might appear, and the bearish pattern confirms their presence. This combination provides a strong signal to consider exiting a long position or even initiating a short position. You are not just trading a pattern, you are trading a pattern at a strategically important price zone, which significantly improves your odds. For your homework, I encourage you to open a price chart of any market. Practice identifying key support and resistance zones by drawing horizontal lines. Then, look closely at what happens when the price reaches these zones. Can you spot any of the patterns we discussed? Look for bullish engulfing patterns at support and bearish engulfing patterns at resistance. Notice how often a doji appears at these levels, signaling a potential turn. The more you practice spotting this interplay between patterns and levels, the more intuitive it will become. This is how you move from simply reading charts to truly understanding the story the market is telling you.